This chapter deals with extending credit to our customers. So we're going to look at the idea of shorter-term credit, which is when we sell something to somebody on credit, which involves accounts receivable. And whenever you have accounts receivable, you have the potential for bad debt expense, which is people that you sell to don't end up paying you. And then also we're going to look at notes receivable, which is when you extend credit for a longer term and have interest that you earn by extending that credit. We're going to look at computing the interest on that note receivable on that longer term credit. So the first thing we're going to do is we're going to look at the trade-offs of extending credit and look at a few other learning objectives in this chapter. So as usual, the chapter is broken down into a few learning objectives. I believe there are 4 in this particular chapter that we'll look at. So let's talk about the trade-offs for extending credit. So the only real reason to extend credit is to get more customers to buy from you. So the advantage of extending credit is that it'll increase your revenues because it will increase your customer base generally. Disadvantages, of course, once you extend credit, you have to track your receivables, you have to do the billing, you have to do all of that. So number one, there are increased wage costs involved in performing those duties. Secondly, whenever you extend credit, you will incur bad debts. In other words, you will extend credit to people who don't pay. They might have good intentions of paying. Something might happen after they buy the stuff to where they can't pay. They go out of business. Sometimes you don't do due diligence in your credit checks and you just extend credit to people who had no intention of paying in the first place. Those kinds of things. So you most likely will incur bad debt costs if you extend credit. And then third is when you make a sale on an account. In other words, somebody buys on credit from you, you've agreed to give them a certain amount of time to pay. So you're not going to get the cash right away. You're going to delay the receipt of the cash, and you kind of have to factor that into your cost structure as well. Okay, and the second learning objective is to estimate and report the effects of uncollectible accounts. Now what that means is we're going to have bad debts. We're in the accrual basis, and so what we have to do is we have to match that bad debt expense with the revenue that it relates to. So we don't know exactly which receivables aren't going to be collectible, so we have to estimate every period an amount of uncollectible receivables, in other words, our bad debt expense, and we have to account for it in the same period that we made the related sales. So that's why we have this this uncollectible account or bad debt expense. We're also going to have a contra asset to the accounts receivable called the allowance for uncollectible accounts. So when each period we will create an entry to that allowance for uncollectible accounts and our bad debt expense, again, using estimates because we're on the accrual basis of accounting and we don't know yet which specific accounts are going to be bad. This slide shows us several things. First, it shows the timing of when we make a sale on credit and when we understand that that particular account receivable is not going to be collectible. It also shows us how to record a sale on credit. We debit accounts receivable and we credit sales revenue for the amount of the sale. It also shows us the relationship of the financial statements, the accounts we use when we sell on credit. The accounts receivable is an asset, it's a current asset, it shows up on the balance sheet. The sales revenue shows up on the income statement. So when we make a sale on credit, we debit accounts receivable, the balance sheet account, which increases our assets, and we credit sales revenue, which is an income statement account, in our equation, assets equal liabilities plus owner's equity. It shows up in that owner's equity piece because sales revenue is on the income statement. Net income goes into retained earnings. Retained earnings is part of stockholders' equity. So that's where that credit is. It's on the right-hand side of the equation. So we have we record sales on account, it affects the balance sheet and the income statement. We don't know at the time of the sale which of those credit sales are going to go bad, so we don't know for sure. So we have to use an estimate of the amount of our credit sales that go bad, and we use experience to make that estimate. So for example, on January 1, we recorded sales on account, and every time it happens, but this is just an example of timing, where we debit accounts receivable, we credit sales revenue. We've affected at that point in time both the balance sheet and the income statement by increasing current assets and increasing sales revenue. At the end of each month, generally, we record our estimate of bad debts from that month, and so we record that estimate with the debit to bad debt expense, which is an income statement account, and a credit to the allowance for doubtful accounts, which is a balance sheet contra asset account. And so that bad debt expense debit is an estimate of the bad debts we incurred by making sales on credit that month. The allowance is an increase to our contra asset account for those bad debts that we believe we've incurred that month based on our sales experience. So you can see bad debt expense again shows up on the income statement, reduces our net income. The contra account, the increase to the contra account reduces our net assets. And so again, that assets equal liabilities plus owner's equity is in balance when we make that entry for the estimate of our bad debt expense. So what we've done is we've already recorded our estimate of bad debts. So the first step in using the receivable, and selling on credit, is to record the estimate of bad debts and create your allowance. Then what happens when you know a specific account receivable is bad? Well, then we have to write off that specific receivable. So again, the two steps to dealing with uncollectible accounts is first, on the accrual basis, you have to create and maintain an allowance for doubtful accounts based on the estimate of the amount of bad debts you're going to have, and then of course record the corresponding bad debt expense. Then the second step, once you know a specific receivable is bad, is you have to write off that specific receivable, and that's what we're going to look at on this side. So now, let's say for example, you know a particular receivable is not going to be collectible. Let's say you have a customer that went out of business, and you know they're not going to be able to pay you, so you have to remove the receivable from your accounts receivable because it is no longer receivable. And since you've already in some ways estimated that that was going to be bad, you also have to adjust your allowance for doubtful accounts, which is your estimate of your total accounts receivable that aren't going to be collected. So you have to reduce the allowance and you have to reduce your bad debts. Your accounts receivable. So how do you do that? When you have a specific account that needs to be written off, you debit the allowance for doubtful accounts, which is your estimate for total accounts that are going to be uncollectible. So you reduce that amount by that specific amount, and you credit your accounts receivable by that specific amount. So what we've just done is we've reduced our contra asset with the debit, and we've reduced our current asset, accounts receivable, with the credit. So we have our net accounts receivable will be the same, and so all of the pluses and minuses end up on the assets side of the accounting equation this time. So when you use credit sales and you account for the inevitable bad debts, this is called the allowance method. When you create an estimate of your bad debts, you debit bad debt expense, credit allowance for doubtful accounts. Anyway, that's called the allowance method. That's what we've been looking at. So the two steps again are at the end of the period, a month, for example, you make an adjustment to record the estimated bad debts in that period in which you've made the credit sales. And then secondly, when you know specific debts are not going to be collectible, you have to write those off. And so those are the two steps in the allowance method. Now there are two different ways to account for and determine your allowance under the allowance method. One is called the percentage of credit sales method, and the other is called the aging method. We're going to look at both of those, and I hope those differences become clear as we discuss those. In the percentage of credit sales method, you're just going to continually add to your allowance each period based on a percentage of credit sales. That's pretty easily. In the aging method, we're going to look at what your allowance is, what your bad debts are, and we're going to look at, like, for example, those that are 30 days old, 60 days old, 90 days old. In other words, we're going to age our accounts receivable. We're going to look at that aging every period, and we're going to say, based on experience, what percentage of that 30-day category haven't we been able to collect? Which percentage of the 60-day category? Which percentage of the 90-day category? It's, et cetera. And we're going to use those percentages to determine what the ending balance of the allowance should be. And then we're going to adjust our current allowance to what we think that ending balance should be. So that's the difference in these two. Under percentage of credit sales, we look at a percent of our credit sales for the month and just add it to the allowance. For the aging method, we look at the aging of our accounts receivable and figure out what the ending balance of our allowance should be at that month, and then adjust the allowance accordingly. Okay, so now we're going to take a look at how to actually adjust for your estimated bad debts. In other words, what are the entries? First, we have Skechers that a shoe company estimates $900 in bad debts at the end of an accounting period. And so what are we doing? What we're doing is we are increasing our contra account, so we're reducing our assets by that $900, and we're recording a bad debt expense, and so we are reducing stockholders' equity by $900. So the entry to record that estimated bad debt for the month, bad debts for the month, is to debit bad debt expense for $900, credit allowance for doubtful accounts for $900. So staying with this example, again, we haven't used either of the two specific methods for estimating what our allowance should be yet, or our bad debts, but what we said is we have estimated, first of all, with Skechers, when they make sales, they debit accounts receivable and credit sales revenue, and then later in the month, we estimate what our bad debt expense would be for making all of our credit sales for the month, and we record that bad debt expense with the debit to bad debt expense and a credit to allowance for doubtful accounts, and that's where we would use one of the two methods, the percentage of credit sales or the aging of accounts receivable method, and we'll look at those in a second. But again, as we make these entries, we can see what accounts we're affecting on the balance sheet. For the month, our accounts receivables are affected because we're making credit sales, and our allowance for doubtful accounts is affected because we are increasing that allowance as we record bad debts. Our sales revenue goes up, of course, as we make credit sales, and our bad debt expense increases by a certain amount as we estimate what the bad debts were from making those credit sales. So now, once again, for the second part of using an allowance method, we find that we have a particular receivable from a customer, in this case Fast Footwear, that we need to write off because the company won't be paying what they owe us. And so, analyze the transaction. What do we have to do? We have to reduce our accounts receivable, and we have to reduce our allowance, which is a contra account. As you reduce that contra account, it has the effect of increasing assets. So we've increased assets by the same amount as we've decreased assets. Accounts receivable, the specific accounts receivable go down, and the allowance goes down. But since the allowance was a contra asset account, the assets increased by the same amount. Okay, so what's, as we record it, what's the entry again to write off a specific receivable? We debit the allowance for that amount, $800 in this case, and we credit accounts receivable for the amount of that specific receivable, which is $800. So this slide might look a little bit confusing. So let's explain what's going on. In the first pink box on top, that's the entry for when we recorded our estimate of bad debt expense for the month. And so it was a debit to bad debt expense and a credit to the allowance for doubtful accounts. That second pink box is where we wrote off a specific account, the second step in our allowance accounting, where we debited the allowance for doubtful accounts for $800 and we credited that specific account receivable for $800. So that's what's going on there. Now the T accounts show us what happens, how those accounts get affected. Accounts receivable only gets affected when we write off a specific account. We increase accounts receivable for specific credit sales as we make them, and we decrease accounts receivable when we write off specific accounts. And so that's the only time that accounts receivable balance is affected. The allowance for doubtful accounts, that contra asset account, is affected both when we write off a specific account and when we estimate what our accounts are. So that allowance for doubtful accounts is the account that gets adjusted both when we estimate what our bad debts are and when we write off specific accounts. And then again, bad debt expense is only affected when we make the estimate of bad debts and record that estimate, in this case with that $900 estimate for the month. Okay, so our allowance for doubtful accounts, again, remains what our estimate of all of our uncollectible accounts are in our total accounts receivable balance. So we keep adjusting that allowance with our estimates and then with our specific bad debt write-offs. So now we'll look at those two methods I mentioned for estimating bad debts. Percentage of credit sales method, which is pretty easy to apply. Every month we just take a percentage of our credit sales and use that as our estimate. Or the aging of accounts receivable, which involves an analysis of our accounts, of all of our accounts receivable. And as you can see here, the percentage of credit sales method is a little bit simpler. The aging of accounts receivable method is a little more accurate. Both are actually quite easy, and so we'll go through those now. So percentage of credit sales method, all we do is we look at our historical figures for bad debts as a percentage of our credit sales, and we just apply that percentage to the current period's credit sales to record our estimated bad debts. So let's say we figure 0.75% of our credit sales turn out to be uncollectible based on our history. We would take our net credit sales for the period, which would be credit sales less returns and allowances on those sales, and we would multiply it times that 0.75%, and that would be our bad debt estimate for the period. So here's a specific example of that. Skechers figures they've experienced 0.75% credits of bad debts on their credit sales in prior periods, so that's what they're going to use. In January, the net credit sales totaled $120,000. So we take that $120,000, we multiply it times that historical bad debt rate of 0.75% or 0.75%, not just 0.75, because that would be 75%, but it's 0.75%. So in other words, it would be, if you're just multiplying it decimal-wise, it's 0.0075. And that gives us that bad debt expense for January of $900. So we would have to record that estimate with a debit to bad debt expense of $900 and a credit to allowance for doubtful accounts of $900. Now let's look at the aging of accounts receivable method. The percentage of credit sales method, since we use credit sales to make our estimate, is called an income statement approach. The aging of accounts receivable method uses our accounts receivable and the age of our accounts receivable as the basis for our estimate. And so it's called a balance sheet approach, since we use a balance sheet account as the basis of our estimates. So the aging method gets its name based on the fact that we look at the different age categories of our accounts receivable. Generally break them into 30-day, 60-day, 90-day, and 120-day and beyond type categories to make that estimate. And the logic behind that is the older a receivable is, the less likely it is we're going to be able to collect that receivable. So the percentage of the older receivables that we estimate to be collectible will be higher than the percentage of the newer receivables or the younger receivables. So to use the aging of accounts receivable method, we have to look at 3 steps to do that. First, we have to prepare an aged list of our accounts receivable. So in other words, we look at all of our receivables and we put them in the categories of whatever we've determined our aging categories are going to be. In this case, it's 0 to 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. And so step 1 is we age all of our accounts receivable. We look at how old they are. Step 2 is we have a historical average of the amount of those receivables, the percentage of those receivables that won't be collectible over time. And again, this is just based on our personal history, or we might get some help looking at, finding these percentages from industry averages or something like that. But what we've determined here is that of our 0 to 30-day receivables, we think about 2% of those will be uncollectible. Of our 31 to 60-day-old receivables, we think 10% of those are going to be uncollectible. 61 to 90 days jumps up to 20% uncollectible of those receivables, and anything over 90 days, we figure we're not going to get about 40% of those. So that helps us estimate our total uncollectible accounts based on what our accounts receivable balance is. So those amounts then should, when you total those up, that's what our allowance for uncollectible accounts balance should be. So step 3, we add all of those amounts up, and we find that our estimated uncollectible accounts receivable is $17,240 based on those calculations we just made. So that $17,240 is what our allowance, the ending balance of our allowance for doubtful accounts should be. So now we have to make an entry to increase that allowance or decrease it, but generally to increase that allowance to $17,240. So in order to make that entry, we have to do an account analysis. If the balance in our doubtful accounts is $15,000 and we know it needs to be $17,240, we have to figure out how to get it there. So if our allowance was $15,000, we need an adjustment for $2,240 to make that entry. So we would end up, and if we're going to increase the allowance, we know we have to do that with the credit. So we would have to debit bad debt expense for $2,240 and credit our allowance for $2,240. And that's the way we use the aging of accounts receivable method to make that adjustment each month. So a couple of final considerations here, and you've probably already thought of this, but of course, our estimates always differ from the actual amounts that we later write off. And they should go both ways. Your estimates, you sometimes overestimate, sometimes underestimate. And so they go, they're going to go both ways. But if that difference ever becomes really large, in other words, what you think your allowance should be, you have to make an adjustment to your allowance to bring it back in line with where you really believe your bad debts are. Secondly, sometimes you write an account off, and then that person turns around and pays you because they feel, they somehow get the money to be able to do that, and they feel obligated to make that happen. And I've seen that happen on a number of occasions. If that's the case, and you've already written that specific account off, remember how you write a specific receivable off. You end up debiting the allowance and crediting accounts receivable. Well, if somebody pays you after you've already done that, you have to reverse that entry. In other words, first you debit accounts receivable and you credit your allowance just to reverse the write-off of that receivable. And then you record the collection, which would be a debit to cash and a credit to accounts receivable. So you're really showing that you've just collected that account receivable like you normally would after you've reversed the write-off.
Was that mine? Must be. Do you want it? There's a few of these lectures where you, like, he like paused it and come back, you start it, and it's where he stopped.
Are you recording still?
Yeah. It's an explanation.
Oh, okay.
That's what I thought. Cause I thought about that when we were doing captions, I'm like, there's like all that dead space, so we put in that, like, no sound.
Maybe we should switch in a minute. It's only like 3 minutes.
Well, if you want, we can go 5 more minutes, cause then you don't have to do full 15. And go a little longer too. Here we go.
So our third learning objective is to understand what happens when we extend credit for a longer term. In other words, more than 30 days or something like that. Oftentimes, we might find that we have to extend credit to a customer or want to extend credit to a customer for a term longer than our normal receivables. Let's say, they accumulate a fairly large receivable, they're having trouble paying it, and we say, okay, well, we'll combine those and create a note, which is a debt instrument that they sign that say, we owe you this amount and we promise to pay interest on that amount, and it's got a term and a stated interest rate and all that kind of thing. So what we're going to do is we're going to take a look at how we compute and report the interest on those notes. So again, that note we issue is called a promissory note. And all that is a document that says we have a right to collect money from our customer, and it will have a stated interest rate and maturity date. And so from the very beginning of issuing that note, we will have a right to collect interest, and we have to be able to then to compute that interest and record our right to receive it, and then of course the collection of the interest when we get it. So this is pretty easy, but remember the thing that you want to put in your brain is that interest rates are almost always stated in annual terms. And so if we're going to record interest for less than a year at a time, we have to compute that interest for the amount of time that we want to record it. So if we're going to record, for example, if we're going to record interest every month, we're going to have to take the annual interest and take 1/12 of that to reflect the month. If we're going to record interest for a week, we take the annual interest and we would record 1/52 of that to represent the week. So what do we need to know? To compute the interest amount, we need to know the principal, in other words, the amount of that note. We need to know the annual interest rate, and we need to know the actual amount of time that we want to be able to calculate. So, look at that second box. If we have a $10,000 note, 6%, and we want to record 3 months we would take that $10,000 times 6% times 3/12, and that would tell us that we have $150 of interest that we will be collecting in for that 3-month period. So that's if we're recording it quarterly. If we're recording it monthly, we would take that $10,000 times 6% times 1/12, and that would give us the monthly interest rate. Even if the note is less than a 1-year note, say it's a 100-day note, look at that bottom line, the interest is still expressed in annual terms. And so again, if we were trying to compute 1 month of interest for a 6% note, we take the principal of $10,000 times 6% times 1/12 of that annual amount, and it would still be $50 for the month. So when we use notes or issue notes, there are 4 key events that we have to remember. When we create the note, which is when we record it, so we would debit notes receivable and credit cash for the, or credit accounts receivable if we're converting accounts receivable. So on the date that the note's created, we have to record the note. At the end of our period, at year end, we record what we call an adjusting journal entry to record the amount of interest that's receivable, but we haven't received yet. And then, when we receive an interest payment, we have to record the cash that we receive for that interest payment and reduce our interest receivable, or otherwise record interest revenue if we haven't recorded the receivable yet. And then number 4, when the principal payment's received, we have to record that as well. So again, 4 key dates: when we create the note, our year end, when we create the adjusted journal entry to accrue interest, number 3, when we actually get paid for the interest, and number 4, when we get paid for the principal. So the final slides for this learning objective are just going to look at what happens in each of those 4 events. So first, we establish a note receivable. So assume that Skechers lent $100,000 to a researcher by creating a note that required the researcher to pay Skechers 6% interest on the $100,000 principal on October 31st, 2010. So how do we record that? We give them cash, so we have to reduce cash, and in exchange we get a promise to pay this note receivable. So we debit notes receivable and we credit cash. Now, if we look at this, that term of that note is still 1 year, and so that would be a current asset, and we would record debit to notes receivable for $100,000 and a credit to cash for $100,000, and that note receivable would show up on our balance sheet under current assets. Now, when we issue financial statements at the end of the year, we have to record that interest that we've earned for the 2 months. Remember, we created the note November 1st. Our end of year is December 31st, so we've got November and December, 2 months of interest that we have to accrue for that note at the end of the year. So we haven't received the interest yet, so we have to compute the interest and then record the interest receivable so that our financial statements are accurate at the end of the year. So again, let's take a look at how we do that. The principal amount of the note was $100,000. The annual interest rate was 6%. So annually, that's a $6,000 interest on that principal, but we're only recording it for the amount we've earned so far, which is 2 months. So we take the $100,000 times the annual interest rate, and then multiply it times the time period, which is 2/12 of a year, to determine what the interest receivable is for that 2 months, which is $100,000. So then we have to go about recording, which is $1,000. So then we have to go about recording that $1,000 interest receivable at the end of the year. So how do we record that $1,000 of interest that we earned? Well, we analyze first. That means interest receivable. We have a right to collect that now for $1,000. So our assets are going to increase. Interest receivable will be a current asset if it's going to be collected within a year, which it is. And we have interest revenue, which will show up as an increase in our net income somehow, which is then, of course, relates to stockholders' equity, which will increase by $1,000. So we record that, a debit to interest receivable for $1,000, assets increase by $1,000, a credit to interest revenue, so revenue increases, which increases stockholders' equity by $1,000, and our balance sheet equation balances. So now the next period, let's look at what happens when we receive interest at the end of the term of the note. Now remember, we've already recorded interest revenue for 2 months, and now we're going to record interest revenue for the other 10 months, plus we have to record the receipt of the entire interest amount. So let's just take a look at how that's done. In total, the interest for a year is $6,000. What we're going to receive is $6,000, but remember, we've recorded $1,000 of that as revenue already, so we have to record the other $5,000 as revenue because it relates to this period, but we're going to receive the full $6,000, so we will get cash of $6,000 for the interest. $5,000 will be credited to interest revenue. The other $1,000 will reduce the interest receivable. So we'll take a look at how that entry works, and then we're also going to get the amount from the principal. So again, at October 31, what happens? We get cash of $6,000. See that under the asset side there? And so we have to reduce interest receivable by $1,000 because we've recorded a receivable for part of that, and then the other part is the interest revenue for this year from January through October of $5,000. So that $5,000 is 10/12 of the annual interest. So how do we record that? We record the cash we received for the total amount, which is when they pay us, debit cash for $6,000. We have to credit interest revenue for the amount of that $6,000 that we earned in this period, which is $5,000. And we have to reduce the interest receivable because they've just paid that off now for the $1,000 that was in interest receivable. And then finally, the fourth part of this is we have to record the payment we get for the principal amount of the note on October 31st as well. So what happens? We get cash that increases our assets by the $100,000, and we reduce notes receivable because they're no longer receivable because we just got paid for it. So assets go up by $100,000 and assets go down by $100,000. How do we record that? We record the receipt of the principal with a debit to cash for $100,000 and a credit to note receivable, which reduces that back to zero again for $100,000. Our final learning objective for this chapter is to compute and interpret the receivables turnover ratio. What that means is, if we're going to be selling on credit, we want to have a feel for how often we are able to collect our receivables, how long it takes us to collect our accounts receivable, so we know, we have a feel for how long our money's being tied up by extending credit to our customers. So essentially, the receivables turnover ratio is a way to visualize how many times on average we collect our total receivables balance over our operating period, so generally, of course, a year. We're comparing our receivables balance to our credit sales amount, and how often, and that will give us an indication of how often we actually collect that over a year. For many people, myself included, we want to convert that into the number of days it takes us to collect our receivables. And so rather than evaluate the number of times, we just turn that number of times into the average number of days it takes us to collect our receivables. So we'll take a look at how we do that. So we're going to take a look at, here's the ratio, or the receivables turnover ratio is your net sales revenue, in other words, sales minus sales returns and allowances, that type of thing, divided by your average net receivables. To get average net receivables, you merely take your beginning accounts receivable balance plus your ending accounts receivables balance divided by 2. Now remember, our beginning accounts receivables balance for this year, January 1, was our ending receivables balance for last year, December 31. So you take your beginning receivables balance and your ending receivables balance and you divide by 2, and that gives you your average accounts receivable. So so to convert that number, so let's say we have net sales revenue for the year of $500,000, and we have average net receivables, beginning receivables plus ending receivables divided by 2 of $50,000. That tells us that our accounts receivable turnover ratio is 10 times that we collected our average receivables balance 10 times during the year. Well, I want to know, how does that relate to how long it actually takes us to collect those receivables? And so all I'm going to do is take the number of days in a year divided by that receivables turnover ratio of 10 times, and that's going to show me that on average I collect my receivables in 36.5 days. Why do I want to know that? Well, I want to know that because I can compare that to my credit terms. Let's say I extend credit on I usually extend credit for 30 days. It tells me it's taking a little bit longer in this particular case to collect those receivables than what my credit terms are. So this tells me whether or not I need to adjust my credit terms, whether I need to do a better job of screening the customers to whom I extend credit, those kinds of things. So it's a pretty useful thing to understand, and it's a pretty fundamental concept to anybody who's extending credit to their clients or customers. And a couple final concepts here for this learning objective is, let's say you want to extend credit to your customers using accounts receivable, but you want to speed up the collection somehow. So there are companies that are called factor companies who will buy your accounts receivable and then assume the risk for collecting them, and they charge a fee to do that, of course. And so you can speed up your collections by selling your outstanding receivables to one of these companies, and that will improve the speed in which you collect, but it will also cost you to do that, so you have to do an analysis to see if it's worthwhile for you to make that happen. And you don't have to do that all the time. You can do it, oftentimes companies will get in a cash flow bind and they'll factor their receivables just for the receivables that they have right now. Again, it's just a calculation you have to, or analysis you have to do to see if it's worth it to you to do that versus going out and taking a loan, et cetera, et cetera. And finally, if companies don't want to extend credit necessarily on their own, they can accept credit cards. And that's why you see so many merchants that accept credit cards rather than have their own accounts. If you happen to be in a retail business, for example, it's a lot easier to use credit, to accept credit cards than to establish an account for each of your regular customers. And to do that, of course, the credit card companies charge a fee for every sale, and some credit card companies charge a larger fee than others. American Express is famous for their high fees to their merchants, which is why you see certain merchants not accept American Express, but accept Visa or MasterCard or something like that. So now take a look at the problems for the end of the chapter that follow this, so that you can see some of the solved problems and make sure that you understand the concepts.